The companies selling you artificial intelligence keep telling you the same story. The models get smarter every month, adoption is exploding, and the future is being built right in front of your very eyes. And on the technology, they are right. But the reality is quite different when you look at the bill. Because while the tools get better, the companies behind them are raising prices and pulling back. Microsoft is cutting most of its internal Claude Code licenses by June 30th. Uber burned through its entire 2026 AI budget by April, with 8 months still left in the calendar. GitHub has moved Copilot to usage-based billing, and some developers are reporting cost increases of 10 to 50 times overnight. And OpenAI has trimmed its long-term compute target from its own previously stated $1.4 trillion infrastructure goal down to $600 billion. So today, we explain how some AI services were sold so cheaply that they actually cost more to run than what users pay, why the financing holding up this whole thing looks disturbingly like the dot-com bubble, and why this entire tech narrative is actually a story about your pension. My name is Nick, and this is the Finance Bureau. Now, to understand what's breaking, you have to understand how these AI services were sold in the first place. For the last 2 years, the model was pretty simple. A company pays a flat monthly fee per employee, gets an AI coding tool, and uses it as much as possible. It looked exactly like buying Microsoft Office. But there was a problem. Every time one of those tools runs, it consumes tokens, and tokens cost real money to compute. And as these tools evolved from simple autocomplete into agentic systems that break a task into dozens of parallel sub-processes, token consumption went through the roof. Put simply, a single AI agent can chew through in minutes what a human user burns in days. The flat fee was a fiction, propped up by venture capital and hyperscaler money willing to eat the difference to win market share. And this is where the cracks start to emerge. GitHub admitted it directly in June, saying the old flat fee model forced it to absorb much of the escalating inference cost as Copilot got more powerful. So now you pay per credit, where 1 credit equals 1 cent, and the power users running autonomous sessions are the ones getting hammered. The numbers behind the subsidy are brutal once you see them. AI native product gross margins are projected at around 52% for 2026. And that sounds healthy until you realize mature software businesses run at 75 to 85%. Inference, which is the cost of actually running the model, now eats between 4 and 9% of revenue at public software firms, and up to 23% of total costs for companies still scaling. And the king of this whole industry is the clearest example. OpenAI generated roughly $3.7 billion in revenue in 2024, but lost an estimated $5 billion doing it. And that is a $1.35 loss for every dollar earned. In the first quarter of 2026, its operating margin was negative 122%, meaning it lost $1.22 for every dollar of revenue. The company is projected to lose around $14 billion this year, roughly double last year's losses of $8 to $9 billion. Consider the Sora video platform. OpenAI shut it down in early 2026 after reportedly burning through $15 million a day against a lifetime revenue of just $2.1 million. The technology worked fine, but the unit economics failed completely. More worryingly, per-token prices have collapsed by roughly 10 times since early 2025, which should have fixed the margins. But it didn't. Every efficiency gain is now being swallowed by bigger models and longer context windows, a phenomenon analysts have now started to call LLM-flation. The era of giving every employee Claude Code access is closing, and what replaces it looks a lot less like an Office license and more like an AWS bill. Take Uber as the case study. Claude Code went out to around 5,000 of its engineers in December 2025. Adoption surged from 32% in February to 95% of engineers using AI monthly by the spring. Average per-engineer API costs ran between $150 and $250 a month, with heavy users reaching $500 to $2,000 a month. And by the spring, 70% of committed code was AI-generated. But Uber's COO Andrew McDonald admitted it's very hard to draw a line between those statistics and actually producing more useful features for customers. And that, my friends, is a Fortune 500 executive telling you the return on investment is unclear. And this begs the question of how ordinary investors are supposed to make sense of an industry where the economics are this opaque. And that is exactly where the Finance Bureau newsletter comes in. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy so that you never miss what actually matters. All you have to do is click the link in the description or scan this QR code on the right of your screen to get started. And now, back to the bill that's about to arrive, because the subsidy is only half the story. The other half is how the money moves between the companies building this boom. And here is where it stops looking like a normal industry and starts rhyming with history. The structure works like a loop. Nvidia invests in the AI labs. The AI labs sign multi-billion-dollar cloud commitments with providers like Oracle and CoreWeave. These providers use the contracts to buy Nvidia chips. Nvidia's revenue grows, which validates the next rounds of investments, and the loop spins over and over. In 2026 alone, Nvidia committed over $40 billion across this stack, and the biggest single bet was $30 billion into OpenAI. It put $2 billion into CoreWeave in January, taking an 11% stake. And it reportedly signed a deal to guarantee demand for CoreWeave capacity it cannot sell to third parties. Through this agreement, Nvidia is guaranteeing demand for its own chips through a customer it part owns. Now, let's look at the lab side of this entire loop. OpenAI has committed to a reported $300 billion 5-year cloud deal with Oracle. It has around $22.4 billion in contracts with CoreWeave on top of that. And its total infrastructure commitment runs to roughly $600 billion through 2030. And the weak link in this chain is CoreWeave itself. In the first quarter of 2026, it brought in $2.08 billion in revenue, but it lost $740 million, more than double the loss a year earlier. It carries approximately $24.9 billion in debt and plans to spend up to $35 billion this year. And in 2025, 67% of its revenue came from a single customer, Microsoft, paying for OpenAI's training compute. The whole structure is balanced on chips bought with borrowed money secured against the value of those same chips. If GPU values fall, the collateral falls with them, and the covenants break. And the man at the center of this knows exactly what this looks like. CoreWeave's own CEO, Michael Intrater, said the words, quote, vendor financing do not carry fond memories for somebody of his age. He added it isn't quite like what the telecom suppliers were up to in the 1999 and 2000, but it's not far removed, and that should worry anyone who knows their history. In the late 1990s, equipment giants lent money to their startup customers so these customers could buy the vendor's own gear. Lucent committed $8.1 billion in vendor financing, and its revenue peaked near $38 billion in 1999, and then crashed 69% by 2002, and the company never recovered. Cisco promised $2.4 billion in customer loans, and then watched its stock fall by 90%, taking 25 years to revisit its peak, even as earnings grew sevenfold. The vendor creates the demand it claims to be satisfying. The revenue is real on paper, but the customer's ability to pay is not. And the modern version is much bigger. Peter Bukvar, who is a chief investment officer watching this very closely, says today's AI vendor financing deals are much larger in dollar terms than the ones in the 90s. A GPU-backed debt market has emerged with interest rates near 14%, roughly triple investment-grade borrowing costs. And the smart money has started to notice. At least one large options position, reportedly over $1 billion, has been taken against Oracle, though the fund and its principals require independent verification. And now, here is where this starts to matter for you. Because though you may not own a single AI stock, you're still exposed. The 6 largest US tech names are now worth a combined $22.2 trillion. And that is larger than the economy of every country on Earth except the United States and China. The top 10 names in the S&P 500 now make up roughly 40% of the entire index. At the peak of the dot-com bubble in the 2000s, that figure was around 27%. So, the concentration today is worse than it was at the most famous market top in living memory. But wait, there's more. In one 20-day session rally this spring, just 10 stocks drove 69% of the index's gains. 3 companies, Nvidia, Micron, and Alphabet, drove over 40% of the positive earnings revisions for the entire S&P 500 in 2026. Strip the AI enablers out, and the rally nearly disappears. Meanwhile, the average stock in your pension has barely moved, and this is the trap. When you buy a simple S&P 500 index fund, the thing most retirement accounts are built on, you think you're buying 500 companies. You're not. You're making a concentrated bet on a handful of AI infrastructure names financed by the very loop we just looked at. And that bet is sitting at extreme valuations. The S&P 500 cyclically adjusted price-to-earnings ratio is around 42.8, meaning you're paying over $42 for every dollar of inflation-adjusted earnings. By late May, only 20 of the 500 companies in the index were at all-time highs, and that kind of narrow breadth is exactly the pattern strategists compared to the March 2000 peak. So, if AI monetization takes longer than the market expects or hardware demand softens, the index is dangerously sensitive to a setback in one sector. And this concentration means everyone's pension is now riding on a single hardware trade. And this brings us to the moment that gets real, because the next wave of these companies is trying to go public. The IPO pipeline in 2026 looks enormous on paper and fragile underneath. In the first quarter, 230 companies raised $40.6 billion, but deal volume actually fell 23%. Fewer companies raising much larger rounds, dominated by AI names public markets may struggle to absorb. I mean, look at what's already happened, guys. CoreWeave priced at $40 a share in March 2025, and it now trades with a market cap around $68 billion, while carrying a negative trailing earnings. And the giants are next. Anthropic filed a confidential S1 on June 1st following a funding round that valued it at $965 billion. OpenAI is targeting a roughly $1 trillion valuation for potential filing later this year, while projected to lose $14 billion, and with cumulative losses that could reach $115 billion by 2029. And, the most extreme of all, SpaceX is eyeing a valuation up to $2 trillion, which works out to roughly 91 times its trailing earnings. And that confidential filing trend is the tell. It lets these companies delay disclosing their cash burn rates and unit economics until the last possible moment, avoiding the haircut that comes when a growth story meets a skeptical public market. As one Deutsche Bank note put it, it has yet to be seen how public markets will value these companies once they open their financial statements to scrutiny and explain the still little understood economics of their business models. When margin trajectory becomes the thing investors actually price, the circularity stops being a feature. So let me be clear about what is actually happening here, because the distinction matters more than anything else in this video. The technology is not the bubble. The models are real, they are improving, and the demand for them is genuine. Data center vacancy in North America hit a record low of 1.6% in the first half of 2025. So the physical pull is real too. The bubble is the business model. It's flat-rate AI services priced below the cost of compute and kept alive by subsidies. It's circular financing between chip makers, labs, and cloud providers that manufactures its own demand. And its stock market, where the gains of an entire index rest on the success of that loop holding together. The 1990s telecoms built fiber networks ahead of demand. Correct technology, wrong timing, and a financing structure that proved lethal. Today's AI data centers could be the dark fiber of the 2020s. The winners here are the early venture investors and insiders cashing out through confidential listings, transferring the risk to retail buyers and pension funds. The loser is the ordinary saver who owns the index without ever choosing the bet inside it. The Microsoft moment, the Uber moment, the GitHub moment, these are not isolated stories. They are the same subsidy unwinding in sequence, and the bill behind them is only now becoming clear. But what do you think? Does the AI business model find its footing and grow into these valuations? Or does the financing loop crack first and drag everyone's retirement account down with it? Let me know your thoughts in the comments down below. And if you want to understand how this index concentration could play out when the selling starts, you can check out our video on that right over here. And that's all from me today. As always, thank you guys very much for watching, and I will see you in the next one. This is Nick, signing off.